A big factor that plays a role in trading and investing is price action. But it's not enough to understand candlesticks. It's actually knowing the psychology behind each and how supply and demand works. All gonna be explained in this video. Everything said in this video is very important and it's condensed information. So don't skip anything, it's all important. Let's dive right in. Hey my friend, Zach here, and welcome to the World of Investing, a channel to teach new traders and investors how to get better and improve on their investing and trading. What makes the price go up or down? It's supply and demand. Supply means the amount of shares that being offered in the market for selling, and that's provided by the sellers. And we often call it the ask price or ask. Demand means the amount of shares being offered by the buyers to be bought. Of course, they're caused by the buyers, and we often call it the bid price. So the buyers set the bid price. When supply is greater than the demand, the price is often to go down. In other words, that means that the shares that are offered are greater than the shares that are willing to be bought. So the sellers are more than the buyers. When the demand is greater than the supply, that causes the price to go up because the buyers are lined up and are willing to buy more than the shares that's being offered to sell. So let me give you an example. Let's say the buyers put down 1,000 shares to be bought at a stock price of $10. They're willing to buy at $10, but there's only available 300 shares of that price. So it's bought, we're left with 700 shares. What happens to the rest? The buyer starts to become greedy and they really want to buy that share. So they start bidding over each other. The second batch, for example, 200 shares, they're willing to buy at $10.05. Then there's shares, more shares available. Then there's 500 shares left to be bought. And then 300 shares after that, they're willing to buy at $10.10, and so on. And that's how actually the price go up. In that same case, if the amount of shares that's willing to be sold are 4,000 shares, so there's thousand shares that want to buy, and there's 4,000 shares available, then the 1,000 shares are bought at $10, there's 3,000 shares left. So let's say the other buyer is only willing to buy at $9.95, and some of the sellers are getting fearful, so they really want to get rid of their shares. They start willing to actually sell it at a lower price at $9.95 for the next 1,000 shares coming up. So they sell them, and then there's 2,000 shares left. They sell them at the lower price, and they sell them at the lower price to get rid of their shares. And that concept is actually applied on everything. Houses, cars, anything you can think of has a market of selling and buying. That's how it goes, supply and demand. If there's too few of the things that are available in the market, it gets more expensive because the desires gets higher. And if it's too much in the market, it starts getting cheaper and cheaper because the desire is lower and the supplier wants to get rid of them. Supply and demand are presented in a tool. It's called level 2, or some brokers they call it, or some platforms they call it in-depth market data. I'm not gonna go heavy on it. I'm gonna make a separate video on it because it is a very important topic, but it's gonna take over the whole video. We'll make it in a different video. Basically what this does, it just tells you how many shares are available for sale and how many bidders are willing to buy, and it gives you an idea of the transactions that's going on. Later on, we'll explain more. So now that you understand supply and demand, let's move on to the candlesticks. What is a candlestick? A candlestick is a visual representation of the price movement in the market at a certain period of time of your choosing. You can choose to see candlesticks that happen in 3 minutes, 5 minutes, 10 minutes, half an hour, 1 day, 1 week, 1 year. It's up to you. Candles that are green, that means the price moved up, and candles that are red, that means the price went down. Candles consist of a body which represents the open and close of that time frame price, and top wick and low wick that tells you the highest price it got to in that time period and the lowest price it got in that time period. So each candle gives you 4 price points in that time frame. So on the wicks, the top wick is always the highest, whether it's a red or green candle, and the lowest wick is always the lowest price, whether it's a red or green candle. But the body can change. On a green candle, the open is at the bottom of that body and the close is on the top of that body. In the red candle, it's the opposite. The open is at the top of the body and the close is at the bottom of the body, as you can see in the pictures. So basically, each candle represents a mini battle of a time frame of your choosing. Again, whether it's a 1 minute, 2 minute, 3 minute, 5 minute, 15 minute, half an hour, anytime you want. So the candlestick is easy to read, isn't it? So let's dive in to the different shapes of candles and the psychology, read the psychology behind each candle. So the first candle is the regular candle that looks like this. If it's green, that means it's a bullish candle, and if it's red, that means it's a bearish candle. If it's a bullish candle, that means the demand is greater than the supply. And if it's a red, that means the supply is greater than the demand, basic. So if it's green, that means the price, it opened right here and it went up and down, and it closed above where it opened. And if it's red, the price actually opened right here, went up and down, and then it closed below the open price. The second candle looks like this, and that is called engulfing candle, where the price opened at the level, it went up and down, and it closed at the top. So it opened at the bottom if it's green, and it closed right on the top if it's a green candle. And that, we call it an engulfing candle. It's a strong bullish candle. If it's red, it's a strong bearish candle. It opened right at the top and it demanded it to be right at the bottom. That means the bears have dominated at this battle. And if it's green, that means the bulls have dominated that battle. The third candle looks like this, and we call it the hammer candle. Whether it's green or red, it gives you a bullish signal. And the reason is it opened at the top. It gave us a long drop to the bottom, and the bulls actually managed to pull it back all the way up, back to the top, near the top, above the close or below the close. That still gives us a big signal that the bulls are dominating in that candle. That candle has a long wick to the bottom and a body on the top without a top wick or a very short top wick. And the fourth candle looks like this, and that's a reverse hammer, and that is a bearish signal. The psychology behind it, it opened somewhere in the bottom. The bulls have managed to actually push it all the way up, but the bears dominated at the end and pushed it all the way down to near the actual open price or close price. And there's the fifth candle. It's called doji, or a shooting star. It means it's an indecision, so none have actually won the battle. It has the same length of wicks and very close open to close body. Sometimes it's just a line, sometimes it's just a small tiny difference. And usually after that kind of candles, you expect some kind of move. Doesn't have to be the candle right after, but very shortly, we expect some kind of big move. So whatever the shape of the candle that you see, now you know how to read it, and you know how to read the psychology behind it. You start from the open, you go back up, what's the highest, what's the lowest, and then to the close, and you can tell whether it's very close where the bulls have actually won this battle or the bears have actually won this battle. Putting all those candles together, they start forming a chart. And that chart starts telling you a story. Think of it that way. Every chart gives you an overall story of the battle and the war that's going on. It's a war zone, every chart. And those candles are mini battles that happened actually in that war zone. Some of you might ask, how can we know how hard or how tough that battle was? Actually, if you look at the bottom of each candle, you can have an indicator called volume. And the volume tells you how far that battle went and how hard was it. The higher the volume candle, the harder the battle was. The smaller the volume candle is, that tells you it's not a hefty or it's not a heavy battle that happened in that candle. And the volume indicator looks like this. And it actually it's a visual representation of how many shares have been traded in that certain candle. The bigger the candle is, the higher the volume is. And you can actually, if you look at the right, it tells you how much the volume is pretty much. If you hover over it, it tells you exactly how much the volume is. My friend, that concludes our part 1 of price action and technical analysis crash course in this series. We're gonna have few videos coming up. If you really interested and want to really learn those technical analysis and price action crash course, make sure you subscribe, like this video so it spreads out. You wanna watch the second part, you'll click on that video. If it's not up there, it'll be there next week, and we'll see you in the next video.